Everyone blames reckless homeowners, greedy bankers, or poor people buying houses they couldn't afford. But that's not even close to the real reason the world collapsed in 2008. Because this disaster wasn't random. It was engineered, it was profitable, and for some it was the perfect crime. This is the truth about the 2008 housing market crash, the story they didn't teach you in school. Picture this. It's the early 2000s. The economy's booming. Unemployment is low. Mortgage rates are historically low. The news is full of smiling experts saying, "There's never been a better time to buy a house." Real estate becomes the national obsession. Buying a home isn't just about having a roof over your head. It's about building wealth, investing in your future, and getting your slice of the American dream. And for millions of people, it sounds like the perfect plan. Banks are lending like there's no tomorrow. Real estate agents are promising this house will double in value in a few years. Your neighbors are buying bigger homes. Your cousin just flipped a property and made $100,000 in 6 months. Everyone you know is either buying a home, refinancing, or investing in real estate. It starts to feel like a race, and if you don't join in, you're getting left behind. But behind the scenes, something is off. Home prices aren't just going up, they're exploding. A house that cost $150,000 a few years ago now sells for $350,000. No one's asking why, because no one wants the music to stop. The logic is simple. If my house is worth more next year, I'll just refinance and take the money out. It's a feedback loop. Prices go up because people believe they'll keep going up. This belief creates an illusion of security. People trust the system. They trust the banks. They trust the idea that real estate always goes up. And they trust that if something was wrong, someone would have said something. Spoiler, they didn't. Let's talk about the average person in 2006. They're not reckless. They're not dumb. They're just trying to build a life. They walk into a bank and get approved for a massive loan. No income verification, no assets required. They're told it's a starter loan. Don't worry, you can refinance later. So they sign. They buy a house they probably can't afford, but they feel safe because everyone around them is doing the exact same thing. Here's what no one told them. Those mortgages? Many came with adjustable rates, meaning your monthly payment could double in a year or two. The fine print? Hidden under layers of legal jargon. The risk? Ignored by salespeople who earned commissions on every loan closed. The whole system was built on the assumption that home values would keep rising, and when they didn't, everything would collapse. Meanwhile, Wall Street is taking these mortgages, even the risky, unstable ones, bundling them together into mortgage-backed securities and selling them as safe investments. Why? Because as long as the housing market keeps going up, even bad loans look good on paper. This is where the illusion gets dangerous. People weren't just buying homes. They were trusting an entire financial system to keep them safe. And that system was lying to them. Now let's zoom out. From 2000 to 2006, the U.S. housing market nearly doubled in value. Banks made billions. Wall Street created exotic financial products with complex names like CDOS, collateralized debt obligations. Rating agencies stamped them AAA, the highest safety rating, even when the loans inside were junk. Pension funds bought them. Foreign banks bought them. It was a global confidence game, and everyone was playing. But here's the catch. This wasn't sustainable. People were getting approved for homes they had no realistic way to pay for. Refinancing was only possible if home values kept going up. And when they stopped, it all unravels. The most dangerous part? No one wanted to admit it, because everyone, banks, investors, homeowners, had something to lose if the truth came out. So they kept the illusion going until it broke. By 2007, the cracks were showing. Foreclosures began rising. People couldn't refinance. Loans started defaulting. But most still didn't believe it would collapse, because they couldn't imagine a world where real estate was the thing that failed. That's the illusion of security, a system that tells you you're safe here, while it quietly builds the very crisis it swears can't happen. And in 2008, that illusion shattered. When the 2008 financial crisis exploded, the media, politicians, and financial elites rushed to tell the public a story, a neat, clean, simplified version of what happened. People bought houses they couldn't afford. Americans were living beyond their means. Homeowners were irresponsible. It was a comforting narrative because it blamed individuals, not institutions. It made the crisis feel like a moral lesson. You were greedy, now you're paying the price. And at first glance, it made sense. Millions of people across the U.S. defaulted on their mortgages. Foreclosures skyrocketed. Entire neighborhoods were abandoned. Families were evicted. Banks began to collapse. So the logic followed. If people had just been more responsible, none of this would have happened. Right? Wrong. That version, the official story, is only half the truth. And like most half-truths, it's more dangerous than a lie. Here's what the public was told. People with poor credit were approved for mortgages they couldn't pay back. When their teaser rates expired, payments spiked. Defaults soared. Those defaults led to falling home prices. Banks lost confidence. Markets crashed. Boom. Global financial crisis. Simple. But that version leaves out the systemic machine that manufactured the entire crisis in the first place. Because here's the part they skip. These so-called irresponsible homeowners didn't approve their own loans. They didn't rate their own mortgages as safe. They didn't invent the financial products that were being sold all over the world. Banks did. Wall Street did. Credit rating agencies did. And they did it all knowingly. Let's be clear. Yes, some individuals bought homes that were too expensive. But the real question is, who gave them the money? And why? Why would a bank approve a $400,000 loan to someone making $25,000 a year? Why were millions of loans issued with no income verification, no job, and no assets? Why were these risky loans then packaged, sold, and rated as top-tier investments? The official story paints the crash as a failure of personal responsibility. But what really happened was a failure of institutional responsibility on a global scale. Banks didn't just allow risky lending, they incentivized it. Mortgage brokers were paid per loan, not based on quality. They were actively encouraged to approve as many as possible, even if they knew the borrower couldn't pay. It wasn't a glitch, it was the business model. And when the cracks started to appear, the same institutions blamed the public. They said it was market forces. They said it was irrational behavior. They said no one could have seen this coming. But that's not true either. Many experts did see it coming. Economists, analysts, even insiders warned that the system was built on sand, that these loans were toxic, that the housing bubble would pop. But those warnings were ignored, or worse, silenced, because the money was too good and the risk wasn't theirs to carry. The truth? The people who created the system knew it would explode. They just expected to walk away before it did. So yes, millions of people lost their homes. But the real question isn't, why did they borrow? It's why were they handed a ticking time bomb in the first place? The official story is easy to digest, but it's not the full story. And understanding what really happened is the first step to seeing who benefited when the world burned. But what if everything you've heard so far, like about homeowners, bad luck, or market crashes, is just a distraction? Because the real story isn't about irresponsible borrowers. It's about a financial system that deliberately built a house of cards and made billions while doing it. This wasn't just poor judgment. It was engineered. And this is where the story gets suspicious, because the people who caused it knew exactly what they were doing. Behind the 2008 crash wasn't just reckless borrowing. It was a financial machine fueled by greed, manipulation, and willful blindness. Here's the dirty secret. Wall Street didn't just allow risky mortgages. It needed them. Why? because those loans were the raw material for one of the most profitable inventions in modern finance: mortgage-backed securities, MBS, and collateralized debt obligations, CDOS. Here's how it worked. Banks would take thousands of home loans, good, bad, or awful, and bundle them together into large pools. These pools were then chopped into tranches and sold to investors as safe, income-generating assets. And the wild part? Even if 80% of those loans were high risk, the top slices still got a AAA rating, the highest possible. How? Because the same rating agencies who were supposed to protect investors were being paid by the banks that sold the products. That's like asking a student to grade their own exam and then acting surprised when they give themselves an A+. Wall Street knew these bundles were risky. Emails later revealed internal jokes about selling crap with a smile. Some traders even bet against the very assets they were selling to their clients, making money when those investments collapsed. This wasn't just unethical. It was systemic deception dressed up as innovation. The system was never designed to protect people. It was designed to extract value and leave someone else holding the wreckage. And just when you think you've heard the worst of it, it gets even more surreal. Because the very people who built this house of cards, they didn't just walk away clean, they got richer as everything collapsed. The next part of the story doesn't just reveal failure, it reveals a system that rewards destruction. At first, the system wobbled. Then, it snapped. And when it did, it didn't just bring down a few banks. It sent shockwaves through the entire global economy. Everything that had been built on risky loans, fake ratings, and financial illusions began to collapse. The moment borrowers started defaulting on their mortgages in large numbers, the foundation cracked. Here's why. These weren't just isolated loans. They were deeply interconnected, tied into pension funds, investment portfolios, and even government assets. As mortgage defaults rose, the value of those so-called safe mortgage-backed securities plummeted. Banks began to realize they didn't actually know how much toxic debt they were holding. Worse, they didn't know how much toxic debt everyone else was holding either. It was like a global game of Jenga. Everyone had stacked their profits on top of unstable pieces, hoping it wouldn't be their turn when it all came crashing down. Confidence between financial institutions evaporated overnight. Banks stopped lending, not just to customers, but to each other. And that's when the credit markets froze. Let's be clear, modern economies run on credit. Businesses use it to pay suppliers, governments use it to manage cash flow, consumers use it to buy homes, cars, even food. So when credit dies, everything stops. One of the first major dominoes to fall was Lehman Brothers, a 158-year-old investment bank with over $600 billion in assets. When Lehman filed for bankruptcy on September 15, 2008, it was the largest bankruptcy in U.S. history. The world watched in real time as entire markets panicked. Stock markets crashed, investors pulled out, banks went silent. No one wanted to admit it, but behind the scenes, the financial system was on life support. And then came AIG, the insurance giant. It turned out AIG had insured many of the toxic mortgage products. They had promised to cover the losses, never imagining that the entire market would collapse at once. They didn't have the money to pay. The U.S. government had to step in with a $180 billion bailout just to keep the global system from imploding. Meanwhile, on Main Street, the pain was spreading like wildfire. People lost jobs, millions of them. Homeowners were hit with foreclosure notices. Savings accounts and retirement plans were wiped out. Entire families became homeless almost overnight. And here's the gut punch. While ordinary people were losing everything, the same executives who built the system were still taking bonuses. Big banks, deemed too big to fail, were bailed out with taxpayer money. Billions were injected into the system. But it didn't go to the families facing foreclosure. It went to stabilize the institutions that caused the crisis. The logic was simple and brutal. If we let them collapse, the entire economy goes with them. In Europe, the damage spread fast. Banks in the UK, Germany, France, and Spain had bought into American mortgage securities. When the US housing market fell, so did theirs. Countries like Iceland saw their entire banking system wiped out. Ireland, Portugal, and Greece entered deep financial crises. This wasn't just a financial failure, it was a collapse of trust in banks, in governments, in capitalism itself. The system cracked because it was never built to be stable. It was built to be profitable, and only for a few. And once the illusion broke, the consequences were far worse than anyone had predicted. The economy didn't just slow down, it flatlined. This was when markets froze. Investors weren't just losing money, they were locked out. Hedge funds collapsed. CEOs begged Congress for bailouts on live TV. It was the moment when capitalism met the edge of its own design and blinked. Humor. If money could scream, this is the moment it would have called its therapist. But here's the detail everyone ignores. The banks got bailed out, the bankers got bonuses, but everyday people, they lost homes, jobs, and years of stability. Foreclosures hit millions, suicides rose, families were destroyed. Even worse, the financial system barely changed. The same banks that caused the crash got even bigger. The rules tightened briefly, and then quietly relaxed again. Your rent today? Higher because home ownership fell? Your wages? Flatlined while corporate profits soared? Your cost of living? Linked to a debt system that was never fixed? People think the crisis ended in 2009, but the truth is you're still paying for it today. Let's talk real lives. The woman who lost her home because her mortgage tripled in 2 years, the pensioner whose savings disappeared overnight, the family who had to sleep in their car while their bank CEO got a bonus. These aren't statistics, they're consequences, and they didn't happen by accident. They happened because the system rewarded short-term greed and punished long-term thinking. Finance isn't just math, it's psychology, incentives, and often manipulation. The 2008 crisis wasn't a glitch. It was a symptom of a system built on risky bets and public bailouts. And if you think this was just history, look around. Housing bubbles are back. Corporate debt is rising. The system is still fragile. Every crash teaches the same lesson. When greed wins the short game, everyone else loses the long one. And if you think this story is wild, wait until you hear what happened when the government let Wall Street write the rules. If you liked it, hit subscribe and send it to your friends.